Hello, my name is Bobby Jones, and I'm a retired nurse anesthetist turned apartment investor. I'm also the founder of On Call Capital, an equity firm that seeks to educate fellow healthcare providers and working professionals about alternative investing while also providing you with opportunities to do so. Whenever I'm thinking about a particular investment, I like to make a list of pros and cons to keep things straight in my head. But I think it's important to do this when you're first starting out with any venture that you want to take on. On a broader scale, I like to go over the good and bad of any idea in general first. So I wanted to do this with the idea of investing in residential real estate. What is it that draws people in or conversely turns them away from this asset type? Now, to be fair, that's a bit of a loaded question. We have numerous types of residential real estate out there. We have single family homes, condominiums, townhomes, small multifamily, and vacation homes, and they all act a little bit differently. So for the purposes of this video, we're going to just focus on single family homes. Let's dive right in. Our first pro is that single family homes offer steady income. Residents pay you every month. So as long as that price is over the mortgage, maintenance, and management expenses, then you're gravy, baby. Plus, leases are often for a year or longer, locking in your monthly cash flow for extended periods of time. Next is our first con. Usually, this is a pretty illiquid investment. When you buy a single family home, you're normally planning for 5 years or more of investing. Now, you may be able to get your money back sooner through a cash out refinance, but only if you performed capital improvements or seen significant capital appreciation, which leads us to our next pro. These investments offer capital appreciation. Good residential properties tend to at least hold their value over time. A home that happens to be in a booming area and is well maintained can see significantly higher resale values even a few years down the road. For instance, the average single family home in the US was priced at around $290,000 just 4 years ago. Now that average has jumped to around $375,000 as of last month, which is around a 30% increase in just 4 years. That sounds like some pretty good capital appreciation. Now, next is a con. Single family homes tend to be influenced by highly localized factors. As we all know, not every market is the same. The city of Detroit filed for bankruptcy in 2013 following years of fiscal mismanagement. Job losses in the city led to fewer people being able to live there, and home prices dropped as a result. While the job market and housing prices have certainly ticked up since then, a home in Detroit is still much more affordable than other similarly sized metro areas. All of this is to say, you'll want to research population and job growth opportunities alongside numerous factors in an area that you'd like to invest in. The next is a pro. An investment in small rental properties automatically diversifies your portfolio. This is a big one for me. I used to have my money tied to the stock market for years, and there's inherent risk in that. Even if you're diversified across your stock portfolio, an event half a world away can have a significant impact on those stock investments. Enter in some residential real estate, and voila, now you have an investment that's almost completely separated from the whims of the stock market. Next is a con. You usually need a large initial capital outlay for these kinds of purchases. Typically, you're required to put down around 25% to purchase a single family home, which can be a pretty significant chunk of change. For a $200,000 home, that comes out to $50,000. But that leads me to the next pro, which is that you can buy properties using leverage. This provides you with a significant advantage over other types of investing. When you purchase a stock, you get exactly the amount that you pay for. However, when you purchase real estate, you are able to control an expensive asset for a fraction of its actual cost. Plus, if you're a veteran or qualify in some other way for different types of loans, you may be able to purchase a property for somewhere around 5% of its actual value, which means you could buy a $100,000 property for around $5,000. Now that's pretty cool. Next is a con. You may need active management and expertise when you purchase these types of properties. The best deals that you're going to find out there are in homes that have some kind of distress to them. So unless you're a handyman, you're probably going to need some professional help to get it up to snuff. You may not have much time to actually manage resident calls or routine maintenance requirements. So hiring a local management company should often be factored into your overall costs. Next is a pro. These types of properties typically have lower property taxes than commercial properties. Commercial property taxes are just calculated differently than residential properties, which is why you should familiarize yourself with tax regulations for whichever type of residential property you decide to invest in. Compared to multifamily homes and apartments, though, single-family homes tend to have lower property taxes each year. Our final con: return on investment decreases with vacancies. Now, you could say this about other types of investments as well, but a single-family home is usually vacant as soon as the lease agreement expires. And unfortunately, the more often you have those types of vacancies, the more your return on investment can go down, because each time you have to go in, spruce up the paint, fix any problems, and then you have to have time to find a new resident. It's possible to lose a month or more of rent each time that you have resident turnover. For an individual single-family home, there's only one source of revenue, and that's the rent payment that you receive each month. Now, our final pro is that single-family homes are an effective hedge against inflation. Now, yeah, this is the final one, but it's a big one. Everyone sees prices rising around us. The good news is that you've invested in single-family homes, and now you have a built-in hedge against inflation. If you're renting out a home, you can raise rents to keep up with the local area. And if you haven't done anything with that mortgage, this means that your cash flow from each property should be well ahead of any expenses that you have. Those expenses will stay relatively static over time, while your cash flow will increase substantially over time. Now, I hope that this list helps you out in your investment journey. That's going to do it for this episode. If you found this information helpful, please give me a thumbs up and subscribe to my channel. If you have questions or comments about the video, please feel free to comment below. And if you're interested in getting access to passive real estate investment opportunities, reach out to me here or on Facebook, LinkedIn, or Instagram, or my website at www.oncallinvestments.com. Thanks for watching, and I'll see you on the next video.